Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
Hi, good everyone. Welcome to the Smart Property Investment Show. We're going to roll up our sleeves today and we're going to get into finance. We're going to talk mortgages. We're going to talk serviceability. We're going to talk, can you get a mortgage in this current interest rate environment and under some of the policy restrictions imposed by the lenders? And is it a good time to be taking a mortgage? All very big issues, and to help me navigate what's going to be probably quite complicated discussion is Son Pham. He's the head of mortgages from Rethink Financing. Son, how you going?
I'm good, thank you.
Is it hard to get a mortgage at the moment?
Yes, definitely.
Why is it so hard?
It's very hard because all the rules that the banks have put on. Well, I should say lenders. More so starting with APRA, telling everyone to slow down. But I think everyone's just worried about the environment and where property prices have been. So all about affordability now.
So we've covered this quite a lot on the Smart Property Investment Show. We get different views and interpretations, and for as long as we've been doing this podcast, lending environment has changed, and we spoke at length around APRA requirements, which were put in place probably 3 years ago now, probably a little bit longer, to try and slow down investment lending. And I think it was worthwhile at that point in time. There's quite a lot of heat in the market, property prices rising, and a lot of the debate around it was the fact that property investors are driving much of that growth because credit was so cheap. So when I look at this current marketplace, a lot of people still ingrained in this idea that the interest rate you pay is going to be very much geared towards what the cash rate is. That's not the way it is. Right now we're in a policy environment where policy is dictating the ability for an investor to secure financing and what price they pay for it as well.
100%, yeah.
Is that going to change at any point in time, or you reckon this is the new norm?
I think this is the new norm, to be honest.
Okay.
I think it's, they say that the lending is kind of in check now, but I still think there are a couple more rounds of tightening to go. They're introducing, software to really, clamp down on clients' living expenses and just getting a full overview of everything that the client has. So,
it makes me a bit nervous, and I've made this observation to a couple of people when I've been driving in the car with them. When you see these new apps, you'll see an advert on a bank, for a bank, CBA or ANZ, saying, we've got this new app, please use it, which pretty much helps them to identify every single cent that you're paying and what you're using your credit card for, your savings account for. So this whole process of mapping people's spending, technology has really enhanced that.
Correct,
which is great if you're looking to do better budgeting, but it means that, back in the day, and the day being 4 or 5 years ago, where, serviceability was a lot more of a blunt instrument. Now banks and lenders can really know how you're spending your money. So if you say, I only spend $1,000 a month on entertainment, and they've got your bank statement that says, well, it's actually more like $3,000, and we know because of this here, that's going to slow stuff down. It's going to get harder, isn't it?
Yeah, so it's scary what technology can do right now. Technology, it can look into your bank account and tell you, exactly, categorizes all your expenses. Trialing software at the moment, it's quite scary where, but I think this is where the industry is heading. But this software, essentially, we send you a link. You put in your banking credentials. I mean, it's all encrypted. We can't see it. But the software allows us to go into the back end of your banking. So if you've got multiple bank accounts, multiple loans, it will scrape the data. And, you can get all that information within 30 seconds. It's quite scary.
So you can't bullshit serviceability.
Yeah, that's right. You can't lie to the banks anymore.
And this is the way it is, right? And people need to be conscious about this. I think it still comes down to, what's it, the 3 C's, right? Around whether or not you can lend something to someone. Credit, character, and what was the other one? So the other C was
capital.
Capital.
Yeah, there's about 5 of them.
There's about 5 of them,
there's
right?
About 5 of them.
But this still comes down to character. So a bank can see what sort of person you are by how you spend your money.
Yeah, correct.
And moving forward, it's going to be more and more.
And they've also introduced comprehensive credit reporting.
Comprehensive credit. There's positive credit reporting.
Correct. So they basically say everything you've got. So there's no more hiding anything from the lenders. But it's also a good thing in a sense if you have good repayment history and you're a good quality customer, even though you've got gazillion loans, they would still offer you something. And if anything, they're looking at offering rates now depending on how good you are.
Yeah.
So if you're a customer that's, your credit's not too good, you're late on payments, they'll offer you something, but you'll be paying much more for it.
Yeah.
Whereas if you're a good customer, you get much better, discounts.
So this is the pricing disparity you're going to start seeing. It's moved a little bit over the last couple of years where interest-only variable rates are priced differently from fixed rates. They're priced differently from owner-occupier mortgages, priced differently for first-home buyers. So there's a lot of disparity in pricing right now. And you're saying, Son, that's the way it's just going to be through the future.
Yeah.
So how can you be a better borrower than just be on top of your admin and make sure you make your payments? And
just basically be good. Make those repayments. Don't be late. Yeah.
And you deal with a lot of investors, obviously. So are most investors good, or most investors are a little bit grey in their ability to...
no two people are the same, I guess. Most of the time they are good. We haven't really seen any, I guess, clients who've got bad credit. Because I think generally if you are an investor, you've got your goals, you know what you want to do, and you want to make sure that you can continue that. You don't want to do anything to damage your ability to borrow. We haven't encountered any, I guess, credit impaired customers yet. But you do get the oddball here and there.
So as a property investor, what should I be doing to make sure I'm the best borrower possible? And that being that I can paint the most favourable picture to a lender so they give me the most favourable interest rate.
Yep. Okay. So I guess, first of all, just making sure that all your payments are all paid, nothing late. Having a good history in terms of savings as well. Like when we submit deals, the credit officer looks at, all these applications, and if your one comes to them and it shows, you're earning, six figures or something, but why have you got no savings? You've got a lot of unsecured debt, car loans, personal loans, credit cards. I mean, that doesn't paint a rosy picture. So just keeping all of that in check. Credit card limits, I mean, if you've got a $20,000 credit card limit, even though you don't use it and you always pay it off, but they see that as, credit at $20,000 untapped. So that doesn't help your borrowing capacity. Structure is important as well. P&Is we spoke about before, over interest only. That will help.
So it's just really about having a healthy attitude to the debt that you have and making sure that you are, they talk about responsible lending, right? But it's about responsible borrowing as well.
Yep.
Responsible lending's been a big theme over the last number of years to make sure that banks aren't giving mortgages to people that probably shouldn't have mortgages, or issuing them credit facilities when they clearly can't service it. So, and that's cool. And I think maybe lenders went a little bit too far to their attitude to issuing people debt when they probably shouldn't have do it. But my view is that you're responsible for taking on the debt that you take. And, it sounds a bit hard, but, having an attitude of I didn't know, or I wasn't really aware of what I was taking on, there's no real excuse for that either.
Yeah,
you need to be responsible yourself.
That's right. I mean, we see it all the time. When a customer comes to you for lending, they always tell you on the face value, I earn this much, but it's usually, more than what it really is. And so they overestimate what they earn and they underestimate what they spend or owe. So it goes two ways, I guess. Borrowers want money and lenders want to lend because they make money. So I mean, this is why, NCCP came out, responsible lending, make sure everything's in check, and more so now as well, because they're really, really looking at affordability. Can you really afford it? So the onus is on the customer. So to answer your question that you previously asked, the best way, I guess, to make sure you're in check is yourself. Don't cheat yourself. Don't lie to the bank. Say, I want this, because you get all this debt, you can't service it. You put on IO, and then next thing you know, they come off maturing. You can't refinance, and you're stuck selling it in an environment that's a buyer's market, not a seller's market. So you get yourself in a bit of trouble.
There's a big difference between predatory lending, that is giving debt to people that really shouldn't have it, and at ridiculous or exorbitant rates at a point in time when they're really desperate, versus property investors who I like to think are sophisticated because they're investing in property, biting off more than they can chew. A lot of people go into debt scenarios thinking it's great when everything's singing and dancing, but
that's right.
What happens if you have a life-changing event? What happens if you go from dual income to single income? What happens if you have an illness? What happens? There's a lot of what happens, and I think it's prudent for all property investors to always think about what those what happens are, and I think it's also prudent for a good mortgage broker to actually have those conversations with people, because they might not be aware of it.
That's right. Yeah. So cash flow is very important. As if things happen down the track, how do they, I guess, take on that risk? So 100%.
So what's the future look like then? It's going to be hard to secure, not hard, it's going to be harder than what it has been in the past to secure financing, but the base position is that banks, as you mentioned, lenders make money from lending money. Correct. And lenders want to lend as much as they possibly can in a prudential fashion. So they're not going to make it too difficult. It's just the game's changed a little bit.
Yeah. So I think what's moving forward is, yes, definitely it's going to be harder. I think what they're waiting to see is just a bit of a decline in the property prices to I guess, be a bit more affordable. But more so long term, I think they want everyone to move from IO to PI, principal and interest, to start paying down this debt.
Yeah.
Because, Australia's household debt is at an all-time high. I personally would like to see them relax a bit of some of the living expenses, because, one of the servicing criteria is when you've got a rental property, they take, say, 80%, 70% of rental income. And that's to take into account cost of running that investment property, council rates, insurance and stuff like that. Yeah. But you'll find that that shading is already taken into that account, but they want us to include that in the living expenses, like how much do you spend on, the property maintenance. So we think it's a double up. So I'm hoping they could lift some of those restrictions. The way it is now, it's definitely going to stay. What's happening, we're finding, is the specialist lenders. You'll find that that's what it's about now. You can't just go to a mainstream, lender and one shoe fits all. It's basically policy now. Policy. So that's, if you really want a loan, it's all about policy. Which lender's going to give you what you need.
It's good for a mortgage broker then.
Yeah. Well, if you know your stuff, but it's definitely given us double the workload, that's for sure.
That's cool. So traditionally, a lot of people have just gone to their bank branch and said, "Can I have a loan, thanks?" And for first-time buyers or really vanilla type stuff, it's pretty straightforward. But if investors go down that path, they might not have real understanding of the different types of policies in different lenders and how it might meet their needs at different points of time servicing that debt. So irrespective of you use a broker or not, my recommendation would be to look at a number of different lenders if you're considering taking on debt right now. But my view would be get a shortcut, get a good broker in and let them do all the work, right?
Well, I mean, they say more than 50% of loans are written by brokers.
It's 53% was the last numbers I saw, and growing.
Yeah. So as you mentioned, with the banks, traditionally, people go in because it's just easier. But even we get a lot of customers that come to us and say, "Oh, I'm tapped out with my major. Can you do something?" And I'll check and I'll say, "Well, yeah, we can, but you're very restricted to only a certain handful because their policy is different to the lenders. Let's say the banks. So you could. So yeah, you definitely need, I guess, a panel because even with all lenders, really, they all have limits to customers. They don't like too much exposure for the one client, So once you've hit your tap, your limit there, you really should be going elsewhere anyway.
I look at my portfolio. I've probably got 6 different lenders in it, maybe a few more.
Yeah.
And that's good because it means at different points of time, your portfolio building, you use different lenders based on cash flow, based on earning potential, based on, Commonwealth Bank, for example. Once you get to a particular point with them, they say, no more money. And you go, okay, no worries, time to move on. So,
that's right.
But as long as you're comfortable with the debt you're taking on. So we're talking about policy being the major differentiator in products and pricing right now. And it looks like that will be the case moving forward, and policy set by lenders so they can deliver the best products possible for their bottom line and still make a buck out of it. Policy also directed by regulatory bodies like APRA, who are going to give restrictions around what lenders can and can't do. That's the environment in right now. So interest rates, the RBA cash rate hasn't shifted for quite some time now. It's at an all-time low. Doesn't really matter whether that goes up or down in this environment.
Oh, look, probably not, because all the lenders are changing rates out of cycle, as they call it. I guess traditionally, RBA, when they decrease or increase rates, was to spur on the economy, and that hasn't done so. Because Australians, we have too much debt in property.
Yeah.
So it's like, so what if the interest rate goes down? People are holding on. Well, when it did go down, like a few years ago, before these lending changes, that spurred on the property boom. But now it's totally different, because even if it did decrease, people can't get loans because the serviceability is so hard. So yeah, I think the RBA is in a bit of a pickle, I guess. Do we decrease rates? Even if they do, what's it going to do to the economy? Because no one's really opening up their wallets to go out and spend. They've got too much housing debt, and really we should be paying that down. So yeah, look, I think it doesn't really make a difference at this point in time. So
I think banks serve their shareholders, and let's remember we're going through a Royal Commission right now, and if you looked at any of the advertising on TV, I think it was reminding most Australians that everyone has some sort of investment in a bank through their super funds. So everyone is intimately connected with the success of our banks in terms of their superannuation earnings.
right.
So, we don't want our banks to fail. We want our banks to keep generating profit, and whether or not, and it depends which side of the political spectrum or social spectrum you live, whether or not you think their earnings is way too much for what they do and they should give a little bit back to punters like us who are investing in properties. But we're all invested in a strong and safe and prudential lending environment, and I'm okay with the status quo right now. And I think when I chat with investors, I'm always first to say, hey, look, I wouldn't complain too much. You look at interest rate environment now, it's as low as it has been in a long, long, long time. It's as good as it gets. Property prices are starting to soften a little bit, and I think that's just a natural market equilibrium in place. If you bought at the top of the market, maybe you're not too happy right now, but good investors don't invest at the top of the market.
That's right.
But, investing is a game of finance, and I think you're in an interesting position, Son, because you're so intimately connected with the lending environment, but you're also an investor yourself, aren't you?
Yeah, correct.
So let's have a quick chat about your portfolio.
Yep.
What's it look like? How long have you been investing for?
God, probably the last 2011, what's that? So 7 years, I'd say.
Okay.
Yeah.
Why'd you start investing in property?
My old man's an avid property investor himself, but he's very, different style, negative gearing.
Yeah.
I don't like that strategy because it means you have to work hard to, I guess, service those loans, and you need the properties to have capital growth and then enjoy it, 10, 20 years down the track. And being a general, I really want it now. So, positive cash flow was the way to go for lifestyle as well. A couple of years ago, 3 or 4 years, I met Scott, and loved the guy, helped me with all my property. But positive cash flow, I see it as free money, and it was a good time because credit was cheap. But I guess at the same time, my business as well, I guess the income I generate helps support, if something goes wrong.
Yeah.
But I built a granny flat at the back of my house.
Well, your principal place of residence?
Yeah, my principal place of residence. Okay. It's awesome. It's giving me like a 15% yield. It pays for like 30% of my mortgage on my home. So, it's a no-brainer.
Well, you just lose a bit of your backyard, did you? And that was it?
I had a big backyard anyway, so it was all right.
What sort of assets have you got in your portfolio?
I've got a few jewel keys.
Okay.
I love them because they're just great income.
Like brand new stuff or older stuff?
Nah, I've got older stuff.
Okay.
I've got 2 commercial properties.
Okay.
So I've got a factory in South Australia that's, I bought for, I think, I can't remember, $590 or something. It's giving me about $1,000 a week.
Okay.
I bought a jewel key commercial office for $490, and it gives me about $1,000 a week. I really like that one because the leases are at different points in time.
Yep.
So if one does decide to leave, I still got the other person, pays for it.
So diversity in lease terms is an important thing that a lot of people don't think about. You don't want your leases coming off at the same time because
That's
if you've got
right.
both of them vacant, particularly in commercial property.
Yeah.
It's a bit of a challenge. Okay, what sort of resi stuff have you got?
So the granny flat I like the most. I've got a unit in Sydney that's not that great.
A unit in Sydney?
Yeah, I've got a unit in Sydney that's not that great, but that's slightly positive. But I've had that for a while.
Okay.
Then we've got an older dual key resi in Queensland.
Okay.
And another dual key in Queensland as well.
Okay.
Yeah.
It's really funny. A lot of people, when I ask them that question, they talk about price growth. You've spoken mainly about yield.
Yep.
So you're very much geared to positive cash flow and money in your back pocket. What do you call it? Free money, which is okay. I'd say it's earning money. But what's the long-term vision with the property portfolio? Obviously, you want them to go up in value so you can realise it could increase at a point in time. The assets that you've bought performing well from a capital value perspective?
Yeah, so my Sydney properties have because I got into the market way before the boom.
Where's your Sydney stuff?
In Cabramatta, out west. Yeah,
that's gone really well, Cabramatta.
Yeah, so I bought my land and built, and I've doubled in like 3-4 years. Yeah. So I was quite lucky. And the unit we've had for a very long time. So, but the dual key in the Moreton Bay region that I've had that for about 2 years, and that's gone up probably about $80,000.
Okay.
So it's been okay. The 2 commercials, obviously, they're more of a yield play. And they're pretty new in the last year or so. So I haven't really looked at growth on that, but I don't think it's going to be much different. And this other dual key I bought, it's only probably gone up about $30,000 in the last year.
Okay. Where's that?
That's in Warner.
Okay.
Yeah. So I'm not too fussed about the capital growth because my Sydney, properties have given me that equity to go and do the next one. Yeah. And that one in the Moreton Bay region for $80,000, I could pull out equity there and go again. Yeah.
So is it the yield from your commercial properties pretty much sustaining the mortgages on your residential stuff? Is that where the positive cash flow comes from?
Yeah, 100%.
Yeah. So it's pretty much matched. So you're really much matched, as in your commercial properties are a tool for generating income to carry your residential properties, which will go up probably in value faster than your commercial stuff potentially.
Yeah. So I guess I mean, whilst my Sydney unit isn't that positive, let's say just a little bit, if you group it all together, it's highly positive. And my goal was to help pay off my mortgage quicker. So that's covering my mortgage on my PPOR. And if I just continue making those repayments as I would if I didn't have these properties, that's what I'm doing. So I'm accelerating, paying down my mortgage really, really quick.
Okay.
And I find, if there isn't any capital growth, you've released it that way as well by just paying down debt.
Which is interesting strategy, and I think it's a good strategy in that you've got these investment properties which are generating positivity, and in the process you're driving down your principal place of residence. So how much debt have you got left on your principal place of residence?
About 400.
Okay. When do you think you have that paid off by?
My goal is in another 3 or 4 years.
Okay. Yeah. And that's completely unencumbered. An unencumbered property in Sydney is it's quite an attractive thing, right?
It's still got debt owing on it, but it's more investment debt.
Yeah.
So the equity I used to pull out of that to go buy the others.
Yeah.
So my main goal now is to just pay off the undeductible debt, and then once that's finished, I'll look at maybe paying down the other deductible debt or going for more.
Can you explain that for our listeners quickly around deductible debt and non-deductible debt?
Yeah. Okay, sure. So your principal place of residence, not income producing, right? So technically if you've got, say, $1 million on there, you pay 4 or 5%. You can't claim any of that interest costs. You can't claim council rates, insurance, anything like that. When you have an investment, so if you drew out that money against your PPOR and you used it to buy an investment property, that debt is technically for an investment. So under the tax ruling, that's tax deductible. So the interest you pay off that is tax deductible. Council rates, insurances, any cost involved of running that investment is tax deductible.
Yeah.
Yeah.
And do you think that you'll start drawing down on your principal place of residence equity at a point in time to try and boost your portfolio, or once you get that paid down, you're going to leave it, or you'll get a line of credit against it, or how are you going to play it?
Oh, that's a good question. My wife probably doesn't want me to, but she always...
See what happens when you get there.
Yeah, she's like, ever since I met you, I just got more and more debt. But I call it good debt. But look, I think as an investor, and I can see the numbers in it working, I'd probably keep going, to be honest.
Yeah.
But as long as, risk LVRs don't get pushed out, you want to keep it in check for if there is a bit of a decline. But I've already been I've been paying down the mortgage and I've been drawing it back out, to go buy these investments. So we call it debt recycling in a way, where we've turned that non-deductible debt to deductible debt. Yeah. So I probably will keep going.
That's cool. And are you worried about this decline in pricing? I sat in a session last week, and CoreLogic was one of the presenters there, and they were talking about this decline in prices, Sydney, Melbourne primarily. They were talking about Tassie's done well and should continue to grow. Queensland's relatively flat, but it should grow, but Sydney, Melbourne is softening. Their view was that it'd probably be a downward cycle. It's not going to be too sharp for a couple of years, and it'll be another couple of years to sort of get back up to equilibrium. For a lot of people, that's probably quite concerning as property investors, particularly if you bought at the top of the market and the idea was to capitalise on growth and use that to keep investing. So it's a different market, but does it bother you that it's not a good market to invest in? Should you be investing in property in this market?
That's a good question. I guess it depends on what your goals are.
Yeah.
You get clients that want a PPOR. They live and reside in Sydney, work, their life's here. I think property investing isn't a short-term game. It will, we go through cycles, and we're just going through one now. So, if affordability is there, you can manage your risks. I think get in, because, you've got a lot of infrastructure works happening in Sydney as well. So, this should help in the long term drive prices up again. Right now, we're just going through this whole, APRO, tightening of lending restrictions. And I think once everything is in check, they will look at lifting it. Australians have a big love affair with properties, so I can't see there being a big crash. There is going to be a gradual decline, definitely. There's a lot of things off the table that's, I guess, reducing that growth. Maybe it's on purpose. Maybe the lenders are not the lenders. The regulators are doing this because they want an even spread of people, of money going to other capital cities.
Maybe.
So
you never know the logic, but I'm actually quite excited about it when I look at Sydney and Melbourne. I'll be gearing up to buy at a point in time. And, whether you can pick the bottom, I don't know. But I think there's going to be buying opportunities in not the immediate months ahead, but in the mid-term period. So we'll be gearing up to capitalise on that.
It's definitely a buyer's market out there right now.
Yeah, and I actually saw some numbers the other day that migration is continuing. I think we'll tip over 25 million, I think it's this week or this month, in terms of population, and that doesn't look like it's going to abate. So, I think the long-term projections or rationale for why property should grow in value, it's all there. We're spending a lot of money on infrastructure at the moment.
That's right.
In our eastern seaboard capitals, preparing for the future. I think of Sydney, for example, there's new train lines going all over the joint.
Yeah, that's right.
Which is good, So it is a bit of a market normalisation, and I would be very conscious about this as a property investor. I probably wouldn't be looking to strip too much equity out of any Sydney or Melbourne properties.
Not now.
I'd be leaving some fat in there, to be honest with you. I'd be keeping your LVRs as low as possible. But be ready. Get ready for new markets in the future. That's my view of it all.
Yeah, 100%. So it's a long-term game. So, for those, I guess, clients who've bought in at the high, you're just going to have to ride it out.
You've got to sweat it out. And this is why you should buy within your means. So don't take the biggest mortgage you possibly can, because sometimes prices go down, and you don't want to go in at 80% and potentially end up at 90% LVR purely through price decreases.
I think it was a massive fear of missing out. So and it didn't help with banks just giving out money, cheap credit, and people would go to auctions. Overspend, and that's what's put them in this position, because they hear of people who, the good wins where they've bought in, say off the plan high rise. 2 years later they've made 200 grand, and they didn't. All they put in was 10%. And they're trying to chase those wins, and unfortunately,
that's not the norm though. Like, that's what you hear. You see these, you get these glossy brochures for people selling off the plan. And it's not an off the plan beat up, but there's a lot of people hurting in that space right now who have committed to off the plan purchases at a point in time when there was huge foreign investment coming in from China, right. And a lot of those guys are pulled out of the market. You've got a lot of empty stuff that's not going to settle.
That's right.
I'd be worried. I'd be worried. But that's not to say off the plan investments don't work. A lot of people have done very, very well, very well out of it. But Son, really enjoyed it, mate. Thanks for coming into the show.
Thank you. Thank you for having me.
Been a good chat. Keep it up. That's Son Pham. He's from Rethink Financing, mortgage broker. And if you're not using a broker, I highly recommend you do it, particularly in this current interest rate environment. You need to be challenging your lender whether or not the deal that they're putting in front of you is the absolute best. And it's good to consider multiple different solutions, the financing solutions for multiple different lenders, because not all lenders are created equal, and there's a lot of disparity between pricing. You never know, and I won't go into the details of how lenders lend money, but at different points in time they'll have different incentives to try and settle loans, and a lot of them will be based on the flow of business coming through, or interest rates, or their ability to access capital. So if you shop around, you might find a point in time where one particular lender has got some really good rates to try and win your business. So speak to a broker, and they should be able to help you out. Thanks for tuning in to the Smart Property Investment Show. It's always a pleasure to have you with us. Our goals, our objectives with this is just to try and help people make more informed investment decisions, so you're not one of these people who over-leverage, over-invest, and end up struggling to not only service your loans, but all the stress associated with that as well. So there's no excuse not to be a smart investor, and hopefully this podcast helps you to realise those benefits. If you're not tuning in to the podcast on a regular basis, just click subscribe wherever you're listening to this right now. We do lots of stories on smart property investment as well. Just go to smartpropertyinvestment.com.au. We're also on social media. Just search Smart Property HQ. You'll work out and find out what we're up to. If you want to subscribe to our morning market intelligence, so you're the first to know what's going on in property, it's smartpropertyinvestment.com.au/subscribe. And please do keep those reviews coming in. We had one recently from a Josh Lauder. Thanks, just call out to you. Thanks for spending the time to leave us that note. It really makes a difference here to the big team behind the microphone here. We're putting all this together. So keep them coming. We like the 5 stars. We really do appreciate it. We'll be back again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.